The slides that I will be showing you today, the presentation, is actually a short version of the presentation that we usually give exclusively to our clients. But of course, we make an exception for the PSE. All right, so today we'll be talking about fundamental analysis. Okay. Um, I think that most of you are already in the market, as the survey earlier showed. So most of you might probably be familiar with the concepts that we will be talking about here. Okay, so let's start off with a blank, a clean slate, so to speak. Okay, we have a different approach in terms of explaining the concept of the market. We believe that going through the process itself is a better approach for you to be able to grasp the ideas in the market. I mean to say, it's learning by doing. Okay, so indulge me in this presentation. Let's begin with an assumption that you are looking for a stock to buy in the market, okay, today. And most of us would probably be looking at the reports of brokers, probably looking at the newspaper reports, and even, shall we say, watch the analysts being interviewed on television. And oftentimes we hear people talking about, the good, decelerating inflation, the good economic growth, and lower interest rates, which puts focus on a particular sector, like the consumer retail sector. So since we have money to invest, we look for where we can put it, and what comes out to us is the consumer retail sector. So we try to focus on consumer retail. Now, if you look at the PSE's list of companies, there are a number of retail companies there under the retail subsector of the broader services subsector. Now, let's pick three, for example. Okay. You have Pure Gold Price Club, Robinson's Retail Holdings, and Metro Retail Stores Group. I'm sure all of you are familiar with these companies. Now, to get to the point, the first thing you examine is how much these stocks are trading. Okay. So when we looked at the prices, Pure Gold at that point was at 57, Robinson's Retail was at 79, and Metro Retail was at 3.32. Okay. These prices are based on the closing prices as of the end of the first quarter of 2019. Okay. Now, based from this price point alone, you might probably say that that Metro Retail might probably be the cheapest in the lot, and you might be more inclined to buy into this stock. But the question is, okay, are you going to buy based on these price points alone? So which of these stocks will you choose? Now, quite obviously, at 3.32, you might probably say this is the cheapest among the stock. The question is it possible that Metro Retail at 3.32 isn't exactly the cheapest among these companies? Is it possible that Robinson's Retail at 79 is actually the cheapest? The answer to that is yes. But before we get to that, this problem or this question actually brings to the fore the concept of price versus value. Okay. We have all heard about the phrase, price is what you pay and value is what you get. So going back to our example, okay, we have the three stocks, Pure Gold, Robinson's Retail, and Metro Retail, the prices we mentioned earlier, but we do not know what their values are. Okay, so we have question marks in the column for the values. Okay. This is what we will seek to find out. Okay. So this is the reason why we are all here. Okay. We are going to do security analysis. Okay. The purpose of doing security analysis is to identify opportunities for investment and trading gains. Okay. In short, we are going to look for what we call mispricings. When we say mispricing, it's the market undervaluing, fairly valuing, or overvaluing particular stocks or investment instruments. So fundamental analysis or security analysis does not only apply to the stock market, but in other investment fields as well. But of course, for our purpose, we'll be focusing on the stock market. Okay. So what is fundamental analysis? Okay. It's basically a tool that helps us to measure the intrinsic value of an asset by examining related economic and financial factors. Now, that might sound a bit esoteric, but at the end of the day, we want to look into how much a company is really worth, given, okay, given its assets, its liabilities, its income potential, its revenue generation, its business model, everything else about the company, as well as the environment at which it is operating. Now, there are two fields to fundamental analysis. One is quantitative analysis. This is where we deal with the numbers, the financial and operating numbers of the company over specified period of time. And the other is qualitative, where we focus on the intangibles. We look at management, we look at the business model, we look at other factors that do not necessarily lend themselves to numerical measurements. Okay? But at the end of the day, what we are looking for is a value that we can compare with the current price of the market. Okay? And it is this value versus price that creates what we earlier mentioned as mispricing. All right. So going back, again, these are the conditions. No? Once we are able to find out the value of a stock, we can compare it with its market price. If the market price is bigger, higher than the value that you arrived at after your analysis, then we can say that the stock is being overvalued by the market and therefore might be a good candidate for selling. Conversely, if the price is lower than the value that you arrive at, okay, then it is a potential buy. Given that the rule is price tends to gravitate towards the value. Once investors realize the validity, the reliability of this value and worth of the company, then price tends to go towards that value. The third condition is if the value you arrive at after doing fundamental analysis is equal to your price, then it is a hold, meaning to say the stock is already being fairly valued by the market. You hear people talking about it as being fully discounted by the market. So it's a hold, meaning to say if you have it in your portfolio, you might as well hold on to it or probably sell it. Or if you don't have it in your portfolio, delay any purchases and wait for the mispricing to come up again. All right. So for us to be able to look for and compute these values, there are certain fundamental tools that we use. Of course, the most obvious is we need to have a copy and look into the financial statements of the company we're looking at. Okay. One is the balance sheet, which tells us what the company owns and owes, as well as the equity of the owners in the company. The other is the income statement, which tells us how much revenue the company is able to generate and how much of this revenue translates into profits for shareholders. And finally, you have your statement of cash flows, which basically tells us about the money coming into and out of the company as it goes on its operations. And of course, the most important thing that's we should exercise and should have when we're doing fundamental analysis is a lot of patience. It's not easy to do this fundamental analysis, but it's an exciting field actually once you get used to it. Okay. All right. When we're looking at using fundamental analysis, there are certain things we're looking for in an investment. Okay. When we buy into a stock, we will buy into a security, there's quite a number of characteristics that we look for in this investments. Number one, is it should be profitable. Okay. Of course, we are investing because we want to make money. So we want to invest in a company that is consistently recording earnings, which enables it to provide dividends or generate enough funds to finance its further expansion. Okay. Number two, the company should be efficient. It is able to generate maximum benefit from its assets. It's able to use its assets efficiently to squeeze the most profits or most revenue out of it. And third, liquid. When you say the company is not about to fold, it's not about to default on any obligations, but at the same time, liquidity could also refer to the trading liquidity. Mean to say that there are enough shares out there in the market for you to be able to get in and out with the least friction. And finally, the stocks that you must or we must be investing in should have attractive valuation. Meaning to say it is trading at reasonable multiples relative to its history and relative to its peers. So these are the characteristics we're looking for. And this is what we will be discussing, how to find companies which are profitable, efficient, liquid, and attractively valued. Now, we will be using the three companies we mentioned earlier so we can go through this process. So when we screen profitability, we look at net profit margins, which is basically your net income or the profits that the company generates over a given period of time divided by the revenue or sales. There's also your return on equity, which is net income over your stockholders' equity. How much profit is basically assigned to the owners of the company. And the return on every asset, net income over total assets. Now, to better understand these concepts, let us apply them to the stocks we mentioned earlier. So let's look at Pure Gold first. Okay. Net profit margin. The numbers we're seeing here are the numbers of Pure Gold for the first quarter of 2019 and the first quarter of 2018. So the formula for net profit margin is net income over revenue or sales. Okay. And net income, as you can see in the table, is the bottom line. In the first quarter of 2019, net income was 1.5 billion pesos. The revenue or net sales for the same period was 34.9 billion pesos. So we simply insert that into our formula, net income over 1.5 billion over 34.9 billion. We arrive at the net profit margin of 0.0432 or 4.32%. Now, as it by itself, 4.32% really means nothing. So first we compare it to what the profit margins were last year. And when we compute that, the 2018 first quarter net profit margin for Pure Gold was at 4.35%, which means the company was simply able to maintain these margins. Now remember, there were rising costs last year and early this year, so this is a testament to the company's ability to control its costs and expenses. At least on that note, that's a positive for the company. Okay, so let's keep that in mind. Pure Gold, 4.32 net profit margin. The same applies to Robinsons Retail. Okay, the same formula. You have your net income for 2019 at 1 billion. Your net sales is at 37.3 billion. Okay, so again, that's 1 billion over 37 billion. The net profit margin for Robinsons Retail is 2.69 billion. 2.69%, which is significantly lower than the net profit margins of 4.67 last year. So at least between Pure Gold and Robinsons Retail, as insofar as these numbers are concerned, it seems that for the latter company, the costs have really eaten up on their margins. As you can see, the cost of sales Q1 2018 just 20 billion, jumped to 28.8, almost 29 billion in 2019. Next is Metro Retail. Again, we're looking for the net profit margin. You can do this exercise with me. Net income at the bottom of your screens, 148 million out of revenue sales of 7.8 billion, which works out to a net profit margin of 1.91%, relatively low compared to Pure Gold and Robinson's Retail. But when we look at it from the vantage point of where it was last year, it was at 1.28. So we did see some improvements in the margins of Metro Retail. So using net profit margins, we could probably say that Pure Gold has been the most effective in terms of translating every peso of profit, squeezing profits out of every peso of revenue. Okay, so that addresses our investment characteristic of profitability. So let's put that into later. Let's put that in the table so we won't forget. Now, your return on equity, you have your net income over your common equity. Okay. So net income is 1.5B. Now, common equity here, just to simplify, is just simply your assets less your liabilities. Okay. So that's 95B less 36B. That's 58 billion. So 1.5 billion less divided by 58.5 billion, you have 2.58% return on equity for Pure Gold. Last year, it was at 2.52. So again, you see the consistency in the numbers for Pure Gold, and this is what's important when you're doing fundamental analysis. You try to see consistency, you look for growth, okay? You look for patterns, you look for trends in the numbers. And so far, at least in the two parameters metrics that we considered, we saw Pure Gold so far holding steady in terms of net profit margins and return on equity. Okay. For Robinson's Retail, we apply the same formula. Again, you can do the same. Try to apply the formula, and you arrive at 1.36% net profit margin, and lower than Pure Gold's, but still also a narrower compared to the prior year. Okay. So for Mrs. G or Metro Retail, the return on equity, applying the same formula, results to 1.72%. But if you look at where it was last year, at 1.04%, you see that huge improvement in these numbers. Okay, finally, return on assets. How much revenue that the company is able to squeeze out of its assets. Okay. So it's net income divided by total assets. For Pure Gold, 1.5 billion again. Total assets 95. So you arrive at your ROA of 1.59%. Last year it was 1.36%. So again, you see improvement. You see an improvement in the return on assets for Pure Gold. Okay. So if you recall the numbers we did earlier, basically Pure Gold had steady numbers year over year and a slight improvement in their return on assets. Okay. In terms of reference to Robinson's Retail, net income of Robinson's is 1 billion against total assets of 106 billion. So your return on assets is just a little under 1% compared to the prior year's 1.25%. So again, there seems to be a deterioration in the numbers for Robinson's Retail insofar as these three metrics are concerned. Okay. For Metro Retail, you have net income of 148 million, assets of 4.5 billion, which gives you 1.12 return on assets. Now, compared to just 0.65% last year, so near doubling in the return on assets for Miss G. Okay. So we put that on the table, so we don't forget it. Okay, so here you see Pure Gold's, the three companies' net profit margins, return on equity, and return on assets. So on this basis alone, you might probably say it looks like Pure Gold is so far the most profitable among these three companies. Okay? So that's how you use these profitability measures, not just for the company itself, but in relation to companies within its same industry. Okay? So we move now to the efficiency part. Okay, the assets turnover ratio. How much revenue, how much profit does a company is a company able to squeeze out of its assets? Your accounts receivable turnover. The important measure is actually the average collection period. How long does the receivables of a company remain outstanding? How fast are they able to collect on these receivables, which helps with their cash flows? And the inventory turnover ratio. How long is a company able to push its products to the market and replenish its inventory? Okay. So we look at Pure Gold. These are all retailers, so we would expect relatively high velocity in terms of assets turnover. The formula is net sales over average total assets. Average total assets being the average of the two periods. So net sales is 34.9 billion for Pure Gold. Your average total assets is your total assets for Q1 2019 and Q1 2018 divided by 2, which brings you to about 97 billion. So your average, your asset turnover for Pure Gold is 0.36. Let's think of it as every 1 peso of asset is able to produce 36 centavos of revenue for Pure Gold. So the higher the number, the better it is, the more efficient the company is. So it's for Pure Gold 0.36. We look at Robinson's Retail, applying the same formula, net sales over average total assets. Your net sales of 37.3 billion over your average total assets of 106 billion. Your asset turnover for RRHI is 0.35, more or less equal to where Pure Gold's average asset turnover is. For Metro Retail, you have 7.7 billion in sales, average assets of 13.5 billion. So your asset turnover is 0.57. So obviously, Metro Retail is probably the most efficient in terms of squeezing the most out of its assets. In terms of receivables turnover, okay, net sales divided by average receivables is the same formula as the asset turnover, except that instead of using total assets, you're using average accounts receivables that are found in the balance sheet of the company under current assets. Okay. So you have net sales of 34.9 billion divided by your average accounts receivable for 2019 and 2018, which works out to 3 billion. So your receivables turnover is 11.42. But to better appreciate this number, we divide 1 year by 11.42 and you arrive at your average collection period of 32 days, which means that this company is able to collect on its receivables every 32 days. So that's a fairly good cycle. Usually you have 30 to 60 days, even 90 days with a fair cycle. For Robinson's Retail, okay, net sales of 37.3, average receivables of 2.4 billion, and your receivables are over 15.15. Your ACP, your average collection period, works out to 24 days, much shorter for Robinson's Retail. For Metro Retail, net sales over average accounts receivables, you have 7.8 billion. Over 1.4 billion, your turnover is 5.59 times, okay, or average collection period of 65 days. So it seemed, at least from this vantage point, that in terms of efficiency in collecting its receivables, Robinson's Retail is ahead. Okay. In terms of inventory turnover, okay, Net sales divided by your average inventory. Again, net sales is on top, and instead of total assets or average receivables, you're using your average inventory, also found in the current assets portion of your balance sheet. 35 billion net sales for pure gold. Average inventory is 19, almost 20 billion. So your average your inventory turnover is 1.76. As we did with the average collection period, days in inventory, 365 days in 1 year divided by 1.76. The goods at Pure Gold stays in inventory for 207 days on average. For RRHI, for Robinson's Retail, 37.3 billion. So 17 billion in inventory. The turnover is 2.16 times. Days in inventory is 169 days. Okay, so it's significantly shorter than Pure Gold's. Okay. For Metro Retail, net sales of 7.8 billion. The average inventory works up to 3.7 billion. So your inventory turnover is at 2.08. So the days in inventory is 175 days. So just plug it in to our summary table together with the profitability table earlier, and you have in terms of ATO, that's asset turnover, Metro Retail returns the best good numbers. For in terms of receivables and inventory turnovers, you have Robinson's Retail topping the list. Okay, there's more in terms of efficiency. So now we know which of these companies are profitable and which of these companies are efficient. The third is which of these companies are liquid and solvent. Okay, we limit our ratios to just two: the current ratio, which is current assets or current liabilities, which talks about how a company is able to meet its obligations, short-term obligations, which is basically over 1 year period. And your debt ratio, how much debt or how much of the company's assets are financed by debt. The formula actually there is inverse. No? It should be total liabilities over total assets. So we solve for current ratio for Pure Gold, current assets over current liabilities. Again, you refer this to the balance sheets. These are already computed. Current assets for Pure Gold is 32 billion against liabilities of just 9 billion or just about 10 billion pesos. So the current ratio for Pure Gold is 3.24 times. If you compare that to where it was last year, it was 1.95 times. So that's huge improvement in the current ratio of Pure Gold. Okay. For Robinson's Retail, the current assets over current liabilities, your current asset is 37 billion, current liabilities of 29 billion, works out to a current ratio of 1.26 times. Last year, it was 1.47 times. So slight deterioration, but still not alarming. It's still above 1. So Robinson's Retail has enough short-term assets to cover its short-term liabilities. Okay. And for Metro Retail, your current assets at 8.3 billion, current liabilities at 4. So it's about 2 times current ratio. Last year, it was 2.72. Okay. Still, again, a slight drop in the current ratios, but not alarming as they have more than enough assets to cover their short-term liabilities. We look at the debt ratio. It's liabilities over assets. Okay. For Pure Gold, 36 billion in liabilities against assets of 95 billion works out to a debt ratio of 0.38. So only 38% of Pure Gold's assets are financed by debt. Okay, last year it was at 0.26, which means that the company took on more debt this year compared to last year. Okay. In terms of for RRHI, the same metric, 32 billion in liabilities against 106 billion in assets. Your debt ratio is 0.30, so not far from where Pure Gold is. Okay, and steady from last year. For Mrs. G, Metro Retail, the total liabilities amount to 4.578 billion against total assets of 13.2 billion, which works out to a debt ratio of 0.35. So I mean, more or less, all these three companies have the same debt ratios. Okay, so this is now a summary of the three metrics that we looked at: profitability, efficiency, liquidity, and leverage. Now, those that are in bold are the best in terms of those metrics. So you see that Pure Gold it has the highest net profit margin, highest profitability measures. For efficiency, Metro Retail is the most efficient in terms of asset turnover and in terms of receivables turnover and average collection period, inventory turnover, and this inventory, Robinsons Retail tops that list. In terms of liquidity, current ratio, they're all fairly good. Pure Gold is the highest at 3.24. You might want to look at it again. Why this ratio is that high? Maybe they have a lot of cash lying around. For debt ratio, they're almost all equal: 38, 30, and 33. So now we know which of these companies, by using these financial ratios, we are able to screen which companies might be a good investment for us. As we said earlier, Pure Gold, insofar as year-over-year comparisons are concerned, seems to be steady. I mean, say it is able to hold its numbers consistently. Robinsons Retail have seen a drop in the numbers, while Metro Retail has seen some growth in its numbers. So what does this tell us after we have done this exercise? Number one, it depends on what kind of investment, what your investment bias is, or what your preference is. If you're going for steady stream, you probably want to go with Pure Gold, given these measures. But if you're looking for growth, then there could be something you should look at Metro Retail. Now, for Robinsons Retail, if you're going for a contrarian view, or you're going for a possible turnaround in the coming period, then it could be a candidate for your portfolio. So these numbers tell us which are the best in terms of generating profits, in terms of utilizing the assets available to it, in terms of its leverage. But at the end of the day, the decision point on which of these you will buy will still depend on your investment preferences. Okay, now we've known about that, let us look at two valuation measures that you would often hear people talk about: your price to earnings ratio and your price to book value per share. Okay, let's talk about price to earnings ratio. Your price to earnings ratio for Pure Gold, okay, is simply computed as market price divided by your earnings per share. Your earnings per share, your market price earlier said is 57. Your earnings per share, we use trailing 12 months, is at 2.4. So how did we arrive at 2.4? Your EPS is equal to your net income divided by your outstanding shares, which works up to 0.52. Your trailing 12-month numbers is your full year 2018 EPS. Take away the first quarter and add the first quarter of 2019. So that brings you to 2.4. Okay. At 57 pesos, Pure Gold was trading at 23.75 times its earnings. Now that seems high, but if you look at the 5-year average for Pure Gold, it's 19 to 28 times. For the first quarter of last year, it's at 24.62. But the most important here is to see where the range has been over the last 5 years, and we see that it's still at the midpoint of that range. For Robinson's Retail, the market price is 3.32. Okay, 79, and the EPS is 3.31, trailing 12 months out of the 0.638 EPS in the first quarter of this year. Okay, so that works out to 23.85, almost similar to the PE ratio of Pure Gold. But if you look at the range, it's almost the same. It's almost in the middle as well. It averages between 18 to a high of 30 times earnings. Okay. Last year, it was still at 23.87, so hardly any change there, pretty much stable. There's an almost equal upside and downside to Robinson's Retail in terms of multiples. And finally, for Metro Retail, the market price is at 3.32. EPS trading 12 months is 0.29, again computed from your outstanding shares and net income of totally 0.043 for the quarter, and trade 12 months 0.29. So at that point, at that price, at 3.32, Metro Retail is trading at 11.4 times its trading earnings. Okay. The 4-year average is between 11 to 18. So in terms of this, you see that Metro Retail is probably the cheapest in terms of this multiple because it's trading near the low of its average range. Okay. Now for book value, we simplify book value as your equity to simplify. You have your equity divided by the outstanding shares. The book value for Pure Gold is 20.34. The market price over book value results to 2.8 times. Again, we look at the average. The average is 2.4 to 3.4 times, so it's still near the low end of that range. For Robinson's Retail, again, the same formula. We arrive at a book value of 47.03. It's trading at 79 or 77, which means it is trading at 1.63 times its trading earnings against a range of 2 to 3. So it's even lower than the 5-year average range. So this, this sends us a signal to further examine what is happening to the stock or to the company. Okay. For Metro Retail, these are our numbers. Our book value is 2.52, market price of 3.32. Your price to book is 1.3 times, which is just little below the lower end of the 4-year range of 1.5 to 2.3 times. So again, we go back to our table for the full summary of all the numbers we've looked at. The same thing. In terms of valuation, it looks like Metro Retail is the cheapest among the lot. Okay, so this does not automatically tells us a trading strat. It doesn't immediately tell us to buy into it. It only tells us to examine the stock further for other possible. We would have to know why these metrics are low. Sometimes companies' PE ratios are low because the market is ignoring the company because probably they have something else they know about the company, the prospects. No? Some are being traded at a higher multiple because the investors are confident about the future prospects of the company. Albeit the general rule is that if it's trading at 10 to 15 times PE, more or less, that is supposed to be a bargain. But again, as I said, it only points to a further investigation of the company. Okay. So, all right. Just to give you an idea, the price of Pure Gold, it changed since the end of the first quarter. It's down 19.3% as of yesterday, 19.3% from the end of the first quarter. For Robinsons Retail, it's unchanged. For Metro Retail, it's down 16%. But on a year-to-date, Pure Gold is up 7%. RHI is a little bit under at 1.25%. And Metro Retail is at 12.0%. So the problem speaks of the low valuations, and there could be some opportunities in here. So these are the things that we're looking at when we do fundamental analysis. Before I end, just a few slides left, just an overview. We have the breaking. These are the things that move prices. You have news and rumors, and they tend to reflect on market sentiment, and the sentiments in turn changes the dynamic between supply and demand, and this is what actually moves the prices of the stock. News is a matrix of what usually happens. No? Like, for example, we hear about GDP growth, lower inflation, interest rate cuts. The sentiment of the market is usually positive, and prices usually move north or go up, and the trading action is usually a buy. So as it goes on, negative is higher oil prices, the trade war, okay, and the M&A rumors. The acquired company usually gets a positive response from the market, while the acquirer, it all depends on how they finance it and everything else. And new ventures are usually positive because it provides a new revenue stream for the market. So usually it's a buy. And I said usually. Okay, so you have to further examine it. All right, so GDP, the same thing. Consumer spending higher, we were talking about that earlier as our base for doing this analysis. Inflation interest rates are also positive or negative depending on their direction. Okay, so I think that's about it. If you have any further questions for us, these are the contact details of Philstocks Financial. Thank you very much.